It's definitely the lighter guidance. So I think not only were we looking at the second quarter guidance, which of course is lighter both on the revenue side as well as on the EPS front, but we were also anticipating some kind of a take up for the full year revenue guidance. So remember, the quarter before they had said 12 to 14% for the full year, and they basically just came out this time and reaffirmed that same number. And I think the street was really looking for all the recently implemented price hikes to contribute to maybe at least 100 basis points of improvement in revenue growth. The same goes for operating margin. I mean, when the guidance first came out for operating margin at 31.5%, that was considered to be pretty muted, and I think the street was pretty disappointed last time around. And they continue to be pretty. I think they're still kind of taking a conservative approach, but definitely the street is going to be pretty disappointed on this.
So what do we want to do? Does everybody want to push them on the call with analysts to say, wait, give us a little bit more color around this? Are you being conservative? Is it as easy as that, Geetha?
So I think there are a couple of different things here happening, Carol, especially with the second quarter. So the reason why their revenue guide fell a little short of analyst expectations was because they did implement a big price hike in the second quarter of last year. So they're obviously lapping those increases. So that's one thing to kind of keep in mind. And then the second thing is on the EPS front, and the reason why we're seeing a little bit of pressure in terms of guidance for EPS and operating profit is because they do expect very, very heavy content amortization in the second quarter. So, they think that would ease a little bit in the second half, but in the second quarter, it's going to be pretty heavy, which might be part of the reason why they're still kind of taking a little bit of a conservative stance. And, we've seen them kind of really invest in a lot of different pieces of content, most notably sports, whether, it was the MLB opening day game or the World Baseball Classic, and you have a couple of boxing matches coming up. And so I think with all of that, they're kind of taking probably a slightly more measured, cautious tone.
We don't get actual subscriber numbers anymore, unfortunately, but the company, as you mentioned, boosted its standard plan without ads by $2 to $20 a month. That was in March. Any indication based on these numbers or doing some quick back of the envelope math, what that did in terms of churn or maybe pushing people to the advertising tiers that are less expensive?
Yeah, so historically, Tim, what we've seen is, and we've seen this in multiple price increases that Netflix has done over, the past 4 years or so, is that churn has been pretty low. It is actually, for Netflix, it's actually the lowest across the board. It's about 1.7%. You compare that to about 6 to 8 to 9% for some of the other services. So they've historically seen very, very low cancellation rates. Of course, there is the possibility, with the price increase, that there could be a little bit of tearing down, as you just pointed. I'm not sure it necessarily had a huge impact, at least for the quarter that is reported, but maybe they are factoring in some of that for the second quarter, which is why we're kind of seeing that lighter than expected guidance in terms of revenue growth.
Okay. I mean, listen, I feel like, when we talked about Netflix, right, in the last how many months, the story that gave and gave and gave over the past year was Warner Brothers Discovery. I mean, is there any rethink that was a mistake, or now that has nothing to do with what we're seeing here?
So you bring up a really interesting point, Carol. And I think, when they announced the deal, people were kind of, flummoxed, and they were like, why are you doing the deal? Is it because you need it, or is it just a nice to have? Is it because this is, a once in a generation, once in a lifetime opportunity for you guys to get hands on an asset that will probably never again come to the market? What is it? And I think, people were kind of looking at this first quarter report as, providing some more answers to that. But I think we have more questions than answers at this point, because we're not necessarily seeing a great acceleration in the revenue numbers, in the operating margin numbers, which is exactly what they needed to show in order to basically assuage investors that it did not need Warner Brothers Discovery. So this kind of it kind of leaves investors, I think, a little bit hanging a little bit.
What about the Ben Affleck acquisition?
That is a great acquisition. So, and I think we will continue to see more of this going forward. So that is, I think as we kind of ponder about whether AI is going to be a positive or a negative for some of these media companies, I think we're definitely going to see Netflix kind of flip the script and be more of an AI winner. And that, the Ben Affleck company Interpositive acquisition, which was basically for $600 million. I think it's a really smart, disciplined move, which again helps them really kind of hone in on AI and make it, make it a positive catalyst.
But there's
rather
this
than a
balance
negative
that, and maybe the Ben Affleck element helps because he is a creator. He's a Hollywood creative, more so than an executive. But the scary thing is, I think for a lot of people in Hollywood is like, what does it mean for their own jobs? And is it existential if AI can do what they're doing?
Yeah, and I think Netflix has said this many times, and just the fact that Ben Affleck is obviously he represents Hollywood and the creative community. I think the company itself is really more about offering creators better tools for storytelling. So I don't think it's necessarily replacing them, and that's the same story that Netflix obviously has been saying too. This is just to help them do their jobs better. This is not necessarily to replace them. So we'll see how it all. It's still early days, Tim, and we'll see how it plays out. But so far they're saying the right things, I guess.
20 seconds. The company's going to be okay with Reed Hastings off the board?
I think so. I think he's kind of been in the background now for a while. It's really just been Ted Sarandos and Greg Peters running the show, and I think they will be fine.